Hi there folks, and welcome to Livewire's 100 Top Rated Fund Series. I'm delighted to be bringing you this new initiative from Livewire, and today I'm going to be speaking with Paul Skamvougeras, who's Head of Equities at Perpetual. Paul, great to have you with us today. Thanks for coming along.
Thanks, James. Thanks for having me.
Beautiful setting on a cracking autumn day.
It is. There's no other place to be other than Sydney or Australia for that matter.
I couldn't agree more. We're going to talk about a bit about your background, about investing, and where you're seeing opportunity over the medium and longer term. But as a starting point, just to get inside your head,
yes.
What motivates you? What's the thing that gets you out of bed each day?
I like a bit of a challenge, and I like to learn new things. I think those two things are things that drive me and gives me a bit of drive. And I think that's why I enjoy investing so much, and I'm so passionate about it, is because it sort of fulfills both of those things. What's challenging about being an investor is you might have a predetermined view on a particular stock or macroeconomic theme, but new information comes to hand. You have to analyse that information, and things can change. Same with a stock. Or you get a left field event like COVID, and then all of a sudden everything that you were thinking gets thrown on its head. So it's very challenging. So I find that motivating. Also on the learning front, there's always something new to learn. I've been in the market for more than 20 years, and I'm always learning new things, whether it's a new technology that's come out and trying to understand that, whether it's a new business model and trying to pull that apart and understand how they make money. So I find that quite motivating. Also working in a team. Perpetual has a big team of investors and analysts, different levels of experience, different backgrounds, different viewpoints. So I find that can really, get you motivated thinking in different ways, which is really good. And also, developing the young talent. My journey at Perpetual was coming through the team, off the dealing desk and working my way up, and, earmarking people that have potential that could potentially get there in time. I think that's quite rewarding as well.
You mentioned that you started a Perpetual 20-year investing career. You're now at the top. Is there someone early in the days or an experience that shaped the way you think about investing?
Yeah, well, my first job in markets was at Perpetual. So I had the privilege of working under Peter Morgan, John Sevior and Matt Williams all at the same time.
Perpetual royalty.
Yeah, well, you could call them that, that's right. And I think one of the things that really shaped me as an investor was, leading into the tech boom, we were value investors. We have a pretty conservative investment process, and we were doing what we were supposed to do, picking good companies where we rated management, pretty highly, strong balance sheets, good cash flow businesses, but it wasn't working relative to the market. People were buying companies that didn't have earnings, and that was a tough period. But obviously, when the tech bust came, there was a period of outperformance that was fantastic for a long period of time, and it's actually probably what shaped me as a value investor. I would call myself a value investor, pretty conservative with a bottom-up view. And look, we've gone through that leading into COVID as a value investor. We've stuck to our knitting, and what we've seen is a huge rotation in the last 6 months, which is quite pleasing.
Well, let's take the philosophy and get into the practical application. Take us inside the room at Perpetual.
Yes.
What are you spending the most time, you and the team spending the most time debating at the moment?
Look, there are a lot of issues around the table, but I think the one that we keep coming back to is inflation, and whether we actually are going to see a period of rising inflation. If you listen to the policymakers, central bankers around the world, they say that it's transitory, nothing to really worry about. But there are anecdotes where you think, well, maybe we could be in for a period of rising inflation. If I take it back to Australia, right now what we have in Australia is a very strong outlook for the economy. So consumer confidence is at 11-year highs. Consumer savings levels are double what they were leading into COVID. So the consumer balance sheet in a great position. Business. The NAB Business Survey hit a record high in March and then again in April. And that is the highest reading since the 24 years that it has started. So business is, the confidence is very high. Forward orders for business are at all-time highs. Capacity utilisation is actually above pre-COVID levels, which suggests that there's actually some there's some fuel in the tank for this recovery. It's not just a rebound, it's a real economic expansion. You've also got a government that wants to spend. Josh Frydenberg has come out and said, we are going to spend. So all the signs are there for inflation to take hold. In Australia, though, we're not really seeing much in terms of the readings yet. If I look at the US, we're starting to already see the readings in the US, and a lot of the anecdotes that you read is where commodity prices are. Commodity prices are very strong. Copper's up 100%. Corn and soy are up more than 100%. We know where the iron ore price is at like $215. There's a lot of input cost inflation that we are hearing about in the US, you're reading about in the papers. Warren Buffett came out and talked about his portfolio companies, how they're seeing input cost inflation and they're passing it through to consumers without a lot of pushback. And also the most recent CPI numbers that came out of the US were well above expectations. So we are a little bit concerned that, yes, central bankers are telling you one thing, but when we look at the real economy, there's the possibility, and it's a possibility, that inflation's going to, is something to worry about.
So how does that take shape? How does that materialise in the portfolios that you're putting together?
Yeah, it's a good question. So if we think about it, what we've been trying to think about from a portfolio perspective is the companies that we own, if they are seeing input cost pressure, do they have the ability or the power to pass those costs on, or are they taking that in their margins? So that's a lot of work. What we're thinking at the moment is around that. Which companies have the ability to pass on, I think is
pricing power.
A little bit of pricing power. Commodity stocks are very well insulated from that, but there are other companies where they're using commodities that we need to think about. Also, we're setting the portfolio for a rising interest rate environment, especially at the long end. We know that the central banks on the short end will keep it low for a while, but the market price is the long end, and so we've been positioning the portfolio more to those types of beneficiaries. So beneficiaries of a steepening curve, financials, insurers, and also economically sensitive Aussie domestic cyclicals, because the Aussie economy is strong. We're also positioned there, so builders, construction, retailers.
2020 was an interesting year. We had the big sell-off on the back of a really long bull market. Yes. Question we get a lot from investors is, how has that reset or changed the cycle? If we're to use a simple framework from going from sort of panic or through to skepticism, optimism, and then euphoria. Yes. Where would you say we are in a market cycle?
We're optimistic to euphoric. I think the outlook you can be optimistic about, especially in Australia and also the US. There is some euphoria if we look at what's going on in, say, Bitcoin and particular sectors of the market, unprofitable tech, where the valuations are just eye-watering. But on the whole, I would say optimism is the way I would characterise it.
Okay. The other thing we hear investors spending a lot of time thinking about is some of the longer-term thematics that are at play. I wonder if there's a longer-term investment idea or a trend or something that you think is really important to get right from this point going forward?
Yeah, it's a good question. Well, the last 40 years, bond yields have actually been falling for the last 40 years, and we've reached a point probably where they can't go much lower. So over the next decade, we're thinking about, well, where could interest rates get to, especially when you have monetary policy makers and fiscal policy makers, especially in the US and Australia, very much intent on creating inflation. And that's what we're seeing. So it's not just, monetary policy cannot do much more from here, but now the governments are taking over and they're really, really spending. So, the stimulus that was injected into the global economy to offset COVID was 15% of global GDP. That's $20 trillion across the globe that's been pumped into the system. So there's very much an intention, and you can see from what the Treasurer says that they want to create inflation, in particular wages inflation. Now, all policymakers will say, well, yeah, we like a little bit of inflation. Everyone likes a little bit of inflation. The question is, will it be a little bit of inflation, or will it be something that gets out of control? We don't know that, but I think getting that question or thinking about that over the next decade is quite important. because we could find ourselves in a rising inflationary environment, but also a rising interest rate environment. And we haven't seen that before. I mean, I'm been 20 plus years as a fund manager, and I haven't experienced that. There's a generation of fund managers that haven't invested in a rising interest rate cycle. So it bears thinking about. So what are the implications? Well, let's think about this. So if we are truly at an inflection point for rates, and rates, the outlook is higher, well, first of all, returns probably will be muted because we're going to start seeing discount rates going up, so for equities and property and the like. You know, long duration assets, high growth assets where for long duration, you know, heavily geared, cost of debt will go up. For high growth assets, where all the cash flows are in the future, what you might find as discount rates go up and in interest rates go up is that investors actually want cash flow today and will value that more than cash flow in the future. And also unprofitable companies. As the cost of capital goes up, you might find investors allocating less to the promise of profits in the future and actually allocating more of the pie to, you know, profitable companies today. So they're some of the things we're thinking about.
You've obviously, you know, got the brains trust of your team at Perpetual, all that experience. For our investors and for people that are watching this video, could you share with them one practical tip that could help to make them a more successful investor? Yeah,
the practical tip is always do your own work and try and understand what you're investing in. Try. I see too many people today, everyone's a Bitcoin trader, and when you actually ask, and everyone's made money on Bitcoin, by the way. I don't know who the loser is, but everyone's made money on Bitcoin, and it seems like everyone is treating it as an investment. But when you actually ask people, well, so can you explain it to me? There's not a lot of behind it. I think it's very important to understand what you're investing in, do a little bit of work, also understand what your risk tolerance is. Are you open for volatility? Are you a risk seeker, or are you more risk averse? That's really important also.
Okay, great. Well, listen, I've really enjoyed hearing about some of the thinking that's going into the portfolios and how you think about investing. I was wondering if you could talk to me about an investment idea or stock, something that's ticking your conviction boxes at the moment.
Yeah, this is an interesting one. Recently spun out of Iluka. It's called Deterra. It's a mining royalty company, the first mining royalty company to list in Australia. These royalty companies, there's many of them that are listed over in the US, and they're quite well understood as an asset class, but here in Australia, I think investors don't really understand these assets, and effectively it's an annuity stream of revenue. In this particular case, Deterra own a revenue royalty over Mining Area C, which is one of the big iron ore provinces where BHP produces its iron ore. Now, why is it interesting? We think, in the work that we've done, it's probably arguably the best royalty that you can own globally and one of the highest quality. Reasons being, its mine life. It's probably 50 years, if not more. Counterparty risk. Your counterparty's BHP. That's who you're hoping will pay you. We think they can, you know, meet those obligations. In terms of producing over the cycle, doesn't matter whether iron ore's 220 or 25, the production's going to come out because they're very, very low on the cost curve. And there's no capital to spend. So the royalty owner doesn't have to spend any capital increasing production. And where we are right now, Deterra is going from 55 million tonnes of production out of the Mining Area C province to 145 million tonnes. Now that will be ramping up over the next 2 years. That's all paid for by BHP. In fact, for every million tonnes extra that they produce out of that province, Deterra gets a $1 million cheque, plus the royalty on top. So we think it's just a great asset. It's a single asset. When we look at overseas, those assets, the royalty companies that are more diversified trade at 2 to 3 times MPV. Deterra is trading below our MPV. Our MPV is $4.78. That is struck off $65 iron ore and 70 Aussie. And we know where iron ore is, it's at 217. So we think that's a very interesting opportunity, and the market will slowly come around to understand the quality of that asset.
Great. Well, Paul, I've really enjoyed hearing your thoughts today. Thanks for coming down to the Rocks. It's been brilliant to have you as part of our 100 top-rated fund series, and great to catch up.
Thank you.